Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today would typically be the mayor himself of the great state of real estate in Texas, Mr. Michael Becker, but he's on another due diligence assignment. So we brought the smartest guy in the room in, the professor himself, Mr. James Eng. James, how are you?
I'm doing good. Thanks for having me, Paul.
What's going on in the Old Capital world these days?
Well, we just wrapped up a couple bus tours where we took investors out to see some of the properties that we recently financed and some deals for sale. And coming up in September, we're going to have our big conference. So Fritz will be there and, the Colliers guys will be there. So come on out, come down to Dallas, it's probably going to be a full week extravaganza. So our deal's a happy hour and a full day event, but I'm sure we'll have a couple other events throughout that week. So come on down. September 23rd and 24th is when the actual conference is, though.
Always a great time. There's usually 350 to 400 people coming from all over the United States to come to North Texas, to Dallas, to kind of understand what's going on in the Southwest. So if you do want to come see us in September, Old Capital Conference, oldcapitalconference.com. Get your ticket RSVP to come see us, and we would love to see you if you can make it. And we'll introduce you to some of the fine people in lending, in investment sales, in everything that you think that you want to develop your team if you're looking to invest here in North Texas. So James, you and I have been in banking for a long period of time, so to speak. And when we lend money on real estate, the collateral being probably the most important thing. And there's a couple of different buckets that we will have people invest in real estate that we can pull out as a tool. We can do bank financing. We can do insurance lending financing. This is where an insurance company lends their own money into the deal. We do credit unions. We do CMBS. But one of the things that we do quite often in what we're known for is a lot of agency financing. And that's usually Fannie Mae and Freddie Mac. And those are typically non-recourse loans. So the other ones, whether it's a bank loan or credit union, those are usually, they hold your wallet. Not only do they hold the collateral, but they also hold your wallet too. So those are recourse loans. So when you deal with non-recourse lending, it's the collateral itself and it's the cash flow that the collateral generates. And so the lender with Fannie Mae and Freddie Mac are always going to want to make sure that their collateral, which they are the largest investor in the deal, wants to make sure that it's maintained to its best degree, because the only thing they have is the collateral and the cash flow of the property. And if the maintenance of the property declines, cash flow or the occupancy declines, then there's going to be a problem. And so today in the podcast, I really want to kind of reset expectations of what people who have agency loans, Fannie Mae or Freddie Mac, or are thinking about getting agency loans in the future, what their expectations once they close on an agency loan, what happens, what they can expect, and then what could happen if they don't maintain the property. Things that may be new to your vocabulary that Fannie Mae can use is a thing called an A check. A lot of people have never heard that before. Possible recourse, possible foreclosure, denial of future loans with the agencies. That's the stick that Fannie Mae or Freddie Mac have to make sure that you're maintaining the asset itself. In the podcast today, we have two guys that we've known for a long time that are there to help you. They're the ones that they're the kind of the gatekeepers to Fannie Mae and Freddie Mac. They're the ones that actually issue the loan. They service the loan on behalf of Fannie Mae and Freddie Mac. And they're the ones that are trying to help you not become a problem, form a problem, and trying to solution your problem if you have one. Fritz Waldvogel with Colliers is in the podcast. So Fritz, thanks for being here.
Thanks for having me on, Paul. It's always a pleasure.
So Josh Torvik is with Colliers too, and he's the guy that we're really going to be speaking with, and I want to have you listen to him. So if you can, get a piece of paper and start taking notes with Josh. And So Josh, kind of tell us a little bit about your background. What do you do? What's your title? And what does that mean for sponsors or even limited partners?
Sure. Happy to be here. Again, my name is Josh Torick. I'm the Vice President and Loss Mitigation Manager for Colliers. That was Colliers Mortgage, now Colliers Debt and Structured Finance. History here, cut my teeth at JP Morgan, worked at Greystone, and now Colliers. Been here for 2.5+ years about. And really what I specialize in is asset management, but escalated asset management. So deals that we have done with sponsors in the past that have either turned south for whatever reason, property condition, debt service coverage, any kind of high risk factors get put to my desk and my team. So that's really the short and long. I mean, essentially my job is to prevent any type of loss for Colliers. At the end of the day, that's what matters most for me.
So let's say, people might work with us for 60 to 90 days. Fritz and I, we do the loan on the front end, and then it closes and it goes to asset management. Now asset management takes over the deal. What's the rhythm sort of that you would expect that borrowers are talking to their lender? Like, is it a quarterly rhythm? Is it an annual rhythm? And sort of what does that look like? I mean, Fritz or Josh, you guys can take that and let's say someone did a loan in, let's say 2023, and sort of talk about that sort of quarterly annual rhythm.
Yeah. So, I mean, depending on the experience of the sponsor, let's just say if it's a first time Fannie Mae deal for somebody, everything's going great, right? Production's done their deal. We got a new deal. Everybody's excited. It goes to asset management. And we'll just go into general servicing because at that point, everything's great and we're all positive. And depending on the way the loan closed, a lot of times there will be some repairs that are listed in the loan documents that our asset management team will work with the borrower to remediate within the timeline allowed, usually within that first year. There's timelines for each severity of repairs. There should be a lot of communication in that first year because we want to make sure that you're brought in, you understand what Fannie Mae is going to be expecting of you, you understand what their mission statement is, and then we understand that these repairs that we agreed to upon the loan closing are getting taken care of. So assuming all that runs smoothly, which typically it does, that's the way it should go. You never hear my name or never reach my desk.
All right. So the first year, the borrower really knock out, life safety, deferred maintenance, all that stuff, sort of the 3, 6, 9, 12-month items. And then from there, maybe in the second year, third year, they're maybe doing draws with you guys in terms of CapEx. And then let's say we did a 10-year loan for this person, and now we're in year 5 or 6, and you guys go out and do your annual inspection, I believe. And then at what point, majority of the deals, you guys have a rating system, right? Maybe explain that rating system. And when something pushes too far, do you get involved?
Sure. So there's been some movement on this in the last year. So this would be some good information for everybody, especially your audience here. So typically when we would close a deal, we have a PCA, property condition assessment, an engineer out there. We wouldn't have to get out there for the 2 years. So there was a 2-year lag that was causing problems with people not doing their repairs or keeping up with it. So Fannie has changed that standard to 1 year now on every new deal. We are getting back out there a little bit sooner than we used to. And then the ratings, it's a 1 through 5 rating, the MBA rating form. So 1 is brand new within 5 years construction. After it passes that threshold, it's no longer pretty much eligible for a 1 unless a large CapEx and brought it back. That's very rare. The next rating is the 2, which is where we like to see everybody, which is the goal for Fannie, goal for us. We want everybody to kind of be in that little bit higher tier. We understand that there's a little bit of gray area. Once it crosses to a 3, that triggers annual inspections by asset management. That's a big change that just happened in March of 26. So that's real fresh, just a month ago. So where we were able to third party and help our workloads and have third party inspectors go out to these properties, the quality was not there. there's a little bit of issue there. So Fannie said, we want the actual asset manager on site on the property every year. So that's where you hit a PCR3. And then if we dip farther to a 4, then we're in trouble. Then Fannie Mae is escalating it to a special credits team, which they have delegated in-house asset managers that handle that. That is the group I work with quite a bit. And then 5 would be just completely, those are very rare. That's just complete disaster. Just nothing is inhabitable, just falling off the map. So I haven't seen one of those, knock on wood, in our portfolio. And, so if you got one of those, you were in trouble long before.
So most deals are going to sit in that 2 to 3 range, and pretty much everybody's happy. The lender's happy, the borrower's happy, everyone's happy with that status. And then, so what is the main difference between a deal slipping from a 3 to a 4? Because I see that seems to be where all of a sudden, okay, now you guys don't do your you do your annual inspection, but now we've got a third party coming in, and they're not there for like 2 hours, they're there for 8 hours or what have you. And they're looking at not 10% of the units, but 100% of the units. Like, what sort of triggers that difference, or what's the main items on that 3 to 4? Because I think our goal is to make sure nobody has their property slipped to a 4.
Yeah, that's the point, because the emphasis there is if you slip to a 4, not only do you have an engineer coming out, but now you have to fund. Colliers has to hold those funds. So you're looking at not just having to do the repairs, but you're having to come out of pocket for the whole scope of repairs up front. So that's really the sticking point and really what gets people. So they're not going to provide a set number, Fannie just won't get that granular with it. But I can say the big change from a 3 to a 4 is, one, just cost. If we're looking at huge costs, like roofs that are well past their useful life, asphalt that has just been deteriorating over the last 5-6 years with no crack seal, no seal coating, anything like that we're looking at scope. Another big trigger would be if we're starting to hit double digits in life safety, that would trigger a 4. That's not necessarily high cost, but that is a high cost if you get a lawsuit because you have a life safety and somebody has an issue on your site. So that's why there's multiple ways you could slip to a 4. Generally, the rule of thumb is if you're not on site, you're not seeing it at least quarterly or biannually, that you don't know what's going on. That's my best recommendation for your audience. Is it's worth a plane ticket to actually get on your site and see it and have the management see the owner at least quarterly or twice a year.
So let's say you're sitting at that 4 as a property owner, and you get the PCA and they say, hey, you've got to put up $500,000. I need you to do the roof, some wiring, and a parking lot. And then during that time, can you do a Fannie Mae loan, or are you on a special list at that point?
Their stance will be, if you get a 4, you're put on a check, which is the applicant check. That's what a check stands for, applicant check. So a 4 automatically triggers. That's what Fannie Mae is saying now. We have seen a little bit of wiggle, but that's not their stance. Basically, they're telling everybody, if you let your property go to a 4, we're not going to do a deal with you until you get this fixed. Once you're put on a check, it is very, very hard to get put off. So that's the trigger that really we really got to stop people from going to a 4.
Don't get on Santa Claus's bad boy girl list. Whatever you can do to avoid that and continue to work with guys like Josh and Fritz. Fannie Mae or Freddie Mac, Fannie Mae especially, they have DUS lenders, delegated underwriter servicers, and there's maybe 20 or 22 delegated underwriter servicers. Companies that you've heard of before that have a license that's given away, bought. Companies like you're familiar with, like Wells Fargo or Capital One or Regions. And there's companies that you've never heard of, like whether it's Greystone or possibly Colliers or Arbor or so. They all have the same rule book that Fannie Mae gives everybody. They all have people like Fritz. They all have people like Josh that are eyeballing these properties. So we're not just picking on just Colliers. Everybody has the same thing. And they're all concerned about the quality and condition of the asset. Because remember, the people that are the tenants in the building are one of the things that Fannie Mae and Freddie Mac are trying to help. Those are taxpayers. And the reason why they do 30-year amortizations, or they do non-recourse loans, or they do 10 or 12-year fixed rates, or they do interest only, and that's different from what some of the banks can do, is because they're trying to help the tenants. They're not trying to help really the sponsors so much, but they're trying to help the tenants out. So the collateral is the most important thing. The collateral and the cash flow are the most important thing. So if we start to pull a string that the property starts to deteriorate, then, and you're not taking care of the property, you're not maintaining the asset, you're not at the property, you're not seeing what's going on, Fannie Mae is going to put you in the penalty box. And then they may start pulling strings at other properties that you own. So you never want to get on the bad boy list. Now, again, banks or credit unions, they may not be as critical about the condition of the asset itself, but because they're holding on to your wallet, your personal financial statement, your balance sheet to cure the problems. Fannie Mae doesn't have that. They just have the collateral itself. And so they're going to be eyeballing the property. You know, if you live out in New York or Florida and you own assets in other states, they want to know how many times you've been to the property. They don't want to have you just trust that the manager or the management company is eyeballing the property. They didn't sign that loan. You did. So they want to have a discussion with you. If they're setting something up to go out to the property, I'd go walk with the property if you can when your lender's on the property and get their opinion about what they see as deficiency. Because everybody has a beauty is in the eye of the beholder. Where somebody comes in and says, well, listen, we're making our payments, so why do you care? We're paying on the insurance, we're paying our taxes. Why do you care as the lender of what really the condition of the asset is? Well, it's important. And you want to listen to the asset manager who works for all these DUS lenders on what their vision is, the beauty in the eye of the beholder. Spend some time, fly in, walk the property with the asset manager, see what their opinion is, what their rating is going to be, and some of the triggers of they think is going to be a future problem. A future problem is that if you have to have this PCA, this property condition assessment report, let's say you bought the property in 2018 or so, but Fannie Mae drives the property or gets this risk rating that's below what it should be. They have this PCA engineer come out to the property. Again, they may be pulling a string because they may say, hey, listen, yes, it was approved in 2018 to have the stab block panels, which is the panels that possibly were great and allowable back in 1987 and 1975 when they were available, but they're 40 years old and they have to be replaced. There was a new memo that came out last year, March of last year, and says, hey, listen, if we do a PCA report, property condition assessment report, and it says, even though the loan's on our books for Fannie Mae, those panels have to be replaced. Even though they weren't looking for this, they have to go with all the new memos of what Fannie Mae is looking for. Josh, what did I miss? What else do you think is important?
Yeah, so just following up on that. So I want to reiterate, a 4 is not the end of the world, and fast action by an owner goes a long way. So if we get a 4 rating on just an annual inspection and Fannie Mae says, hey, I want to visit the site, that's typically what happens before a PCA is ordered. I try and get on the property, and I recommend the borrower gets on the property with Fannie Mae that day. Immediate action and attention to that property shows effort. And there's a lot of times, almost 70 or 80% of the time, if I have a borrower on site with me with Fannie Mae on that walkthrough, we'll prevent a check, and we've even prevented PCAs. If they see that they're invested, they're involved, they're on it, they weren't aware, whatever that communication is, that's worth your plane ticket. That's worth your weight in gold, because you're saving yourself a headache, saving yourself future business, future deals. That's just where I want to follow up there.
Yeah. So the property condition assessment report done by the engineer who's looking at the condition of the asset itself. So they're going to look at the exterior, they're going to look at the interior of the property, and they may come up with a number that these things on the checklist may include $500,000. But if you go out to your vendors, whether it's an HVAC vendor that they're having a problem with some of the compressors on the roof or the compressors on the side of the property, and they're coming up with a number of, say, $100,000 to do the repairs, you may go to the vendor and they say, well, no, it can be done for $55,000 or $45,000. You can use these vendors to help you, provided it's the same scope of work to be done. You can use those vendors to help you. And I'm a big believer in putting stuff in writing of what you're going to do. So Fannie Mae or Freddie Mac, they want to see how much money you're going to spend and where it's going to go into, but they also want to see in the timing. Josh, how long is it typically they want to get all these repairs done?
So critical repairs will be within 6 months, and then larger DM will give a year. Life safety within 30 to 60 days. So the actual engineer's report will give a timeline for that. There is some extensions granted. We're allowed to do that as long as the communication there is, then the work is in process, basically. Like you said, there's a remediation plan in place.
So borrower says to me, Josh, I got this $500,000. I don't have $500,000. Maybe I have a 150. What do we do about that? It's been challenging these days. These are usually fixed rates or so. Mm-hmm. Taxes have gone up, insurance has gone up, and now possibly they can raise some money, but they don't have any money in an account. What are you advising folks to do that just don't have the capacity to pay?
Well, I'm not going to give out any of my secrets, but there are tricks of the trade. I have some tools at my disposal that I work with my borrowers for that. A kind of a more broad stance would be a capital call is one thing we've had to ask people do. But there are ways to work with escrows we're holding. There's ways to negotiate with Fannie Mae. The way that there's some wiggle room, if you have a quality asset manager that kind of knows what they're doing and you have a motivated borrower, there's tools for us to be able to work with somebody in that aspect. I can't speak for other servicers because we're the best, but that's how it should go.
All right. And then Fritz, let's say that they were good borrowers back 5 years ago when we made the loan. Mm-hmm. There's been dissension in the partnership and they still want to own the asset, or three people want to own the asset. One person doesn't want to own the asset, blah, blah, blah. But they're not paying attention to Josh and his team. What are some of the triggers that happens with Fannie Mae?
Talk about the bank. It does not end well for that borrower, because I think from my experience, I think once a sponsor kind of changes their tone instead of wanting to, work with you and communicate and kind of goes dark, that's where I think from an asset management perspective and from Fannie's perspective, that they have to come in with a much heavier hammer. And from there, they can, put a deal up for foreclosure. Like you said, depending on how bad it is, trigger recourse because there are bad boy acts in the loan documents. So basically, if you do go the route of being more challenging to work with, Fannie will come back with a much bigger hammer and making sure they do what's right for them and the collateral. I don't know, Josh, if you have anything else you want to add.
No, you nailed it. I think the good point you made there is, yes, these are non-recourse loans, but there's a lot written in those documents that can trigger them switching over to recourse.
Don't be a bad boy or bad girl. and the reason being is that just what Josh was saying and Fritz was highlighting is that if you don't follow the rules, embedded within these loan documents are clauses or covenants that says that, just an example, that, listen, I'm not going to listen to these guys. I'm just going to throw the entity that owns this deal into bankruptcy. And now, just by throwing the entity into bankruptcy because you've asked for maybe some more time, or you're thinking trying to sell the deal and you're trying to forestall it, there's hope down the road, but the bankruptcy is going to give you some additional time. Once you throw that entity into bankruptcy, you've made that loan, you've won that loan from non-recourse to recourse. And we don't want to do that. So that's the last thing that you want to do. And then obviously you'll never do another loan with Fannie Mae or Freddie Mac again. They are the premier. They are the Cadillac. Cadillac is a luxury model these days. They are the Cadillac of financing apartments, and you don't want to have an issue with them. There are other type sources of lenders, but the government gives you the incentive to go with them if you can play by the rules. And this discussion really is playing by the rules and having just open dialogues with your lender, your asset manager, your broker in this case, which is us, who's been around the racetrack a number of times, that kind of knows a lot about what's going on. Fritz, anything more that we should be talking about to give people just a flavor?
I just think, being through a few of these type of deals, is communication is very, very important as you work through a lot of this. So that I would recommend over communicating with your asset manager is for the people that I think have had the best outcome in this situation, over communication and being quick to jump on things is the number one thing that prevents things from escalating and becoming much bigger issue.
I will tell you that Josh and his team in Colliers, I mean, they have I would imagine, probably one of the cleanest books within the delegated underwriting Fannie Mae system. So they don't have a lot of problems. There are a lot of Fannie Mae loans that have had some problems, and a lot of those deals get foreclosed upon, and there's steel fences that are pushed around the property, and all the tenants are evicted because the sponsor has lost the deal. So don't be that one. Don't be that person. James, what am I missing here?
Yeah, we heard from someone at Fannie Mae yesterday, and they reiterated a lot of stuff you talked about, Josh. But what we're seeing on a lot of bridge loans right now is they are switching out borrowers on these deals, and they're modifying terms of the loan. Like they're letting the guy come in. All right, yeah, it was SOFR plus 350, but now it's SOFR plus 2, and then it ratchets it up. But the Fannie Mae guy was like, we can't change anything really on this loan. There's not that many modifications to this loan that we can do. I guess what has been the playbook for, let's say it is rated a 4, the person can't put up the money, it starts slipping. At what point do you step in and just say, hey guys, we got to take this deal back because it's going the wrong way?
Well, I mean, that's kind of a tough question because every deal is different, right?
Right.
Let's just say, for this example, that we have a sponsor with a property that got rated a 4 with a engineer, 500,000, because that's the example we used earlier. They don't have it. That's when I get involved and we have one-on-one conversations. And the first thing I say is, whatever you do, don't stop the mortgage payment. That's not an option. Because you go 60 days there, it's out of our hands. You're looking at a receiver, you're looking at legal fees, all these things are going to be taken out of your profits at the end. So don't add any more bills on top. And then we can go from there. And then I've been doing this a long time. A lot of times there's little tweaks with whatever's going on at the property that we can adjust, we can help, we can turn around. I mean, there's success stories all the time. I took over one in January, and in 3 months, occupancy was up 11%. Repairs from origination they didn't do are all underway. It was a lot of just educating a borrower that wasn't used to the market. And that's okay. You have to, for me, have to just kind of assume everybody doesn't know anything. So then when I have conversations, I'm just informing of what your expectation is, what's going to happen next. So if they can't do the 500,000, going back to the example, I kind of rambled off there, but there might be options that Fannie Mae says, hey, we don't want to necessarily take this over either. So maybe we'll entertain some different types of tools. But that's when it gets elevated to kind of that specialty asset management team, which is a smaller, more specialized team over there at Fannie Mae.
Okay. Yeah. I mean, we've seen, I don't know the specific situation here. There was a deal in Dallas that was taken back by Fannie Mae and a couple of deals in San Antonio. And when you look at the deal, you're like, well, it's 80% occupied. It has a fixed rate. What's the problem? And then it's not until you go drive the property that you see the problem. They maybe have some down units. They just didn't have the money to put up. And Fannie Mae they stepped in before there was a bigger problem.
Yeah. They've got a lot of experience. They've seen a lot of these go south quickly. So their under the breath tone is first loss is the best loss. So they try and get in and get after it. And we are seeing right now is a lot of assumptions, kind of like you said, with new sponsors being brought on. But that's kind of going back to the audience on this call. There's a lot of great deals out there. This is not necessarily, I'm not telling everybody just hold tight. Like, we're seeing some assumptions on deals that management companies were terrible and the borrower wasn't involved and the values dipped in 2 years. And if somebody came in and brought it back, it'll be way back up. So they're getting just huge discounts right now, honestly, across the market. As long as you are active and an involved borrower, I say get in because now is a good time.
Okay, let's say the borrower decides, because a lot of the deals Fannie Mae did, they were based on in-place coverage of 125, and they didn't over-lever the deal when they bought the deal, let's say in 18, 19, 20. But now it's deteriorated the condition of the property and now it's a 4, but they're like, I don't have the 500,000. I'm just going to sell it. I've got 5 million in equity in this deal. I can't get at it, but I can just sell the deal. Does that become an issue, or does Fannie Mae, let's say the new buyer comes in and says, well, Fannie Mae, I'm buying this property. What do you think? Does that go into, is that a problem, or does that guy got to go to Freddie Mac?
Does the property go on a check?
Property, now this is a new development. Now they're creating property check. That is, they are going to, which is just rolled out February of this year. And I was on a couple intro calls this week just to try and listen to questions from other servicers and kind of get myself a little more informed on that. They are going to start tracking properties that keep trading hands and staying a 4, but it's not being caught. They're getting them back to a 3 and then doing the new deal, and then it's back to a 4, 3, 4, 3, 4. So that is something that's going to be tracked in the future. I ran all our properties. None of them are on them because it's a new system, and I think it's going to be kind of everybody puts their part into the database and it's get built by everybody. But that will be something in the future. But if you used to be able to sell your way out of trouble, James, right? And then with rates and stuff like that, and then you have prepayment penalties. If you're looking to take a huge prepayment penalty, sure, you can sell it. Well, I mean, you can sell it and then pay off the loan, but the prepayment penalty is pretty huge. That's why the assumption route is a lot more desirable right now for a lot of sellers. Bring another party in to assume it. Colliers keeps the loan on their books, and then, Fritz could probably talk to that a little bit more because he's on that side.
Sure, yeah, no, it's super common to do the assumption route in today's environment, especially depends when the loan was originated. If it was during early COVID, or during COVID when rates are really low, so it's still very accretive to assume that debt. So we've seen quite a bit more assumptions over the last 2 or 3 years. One question I would throw this over back to Josh is if kind of the situation we were just talking about, the $500,000 for repairs, they're just going to sell out of it, but they never actually do the $500,000 worth of work. So say it sells, new buyer comes in, they pay off the loan, then the seller who sold that property wants to go get a new loan with Fannie. Will that ping that original seller because they didn't actually finish the work before they sold it? So does that impact their ability getting financing in the future?
They'll have to fund that $500,000. That'll carry over to the new buyer.
Correct.
That's essentially, yeah.
But then if they sell it before the work gets done, does that impact their ability to get Fannie financing in the future, in your mind, from Fannie's stance?
Yes, because I mean, if they have a 4 and they have a PCA, property condition assessment done, and 500,000 in repairs, and they just take off, one, they most likely have already been put on a check at that point, so that will carry them. A check used to be, when you're on it, don't even call us. But now there's gray area in there, so they're actually hold a little bit of a button that you can be on a check and do new deals. But that means that they're already flagged and they'll review why you were put on a check, what was the deal. And if they see that you were on this last deal that you just sold your way out of it, didn't do any of the repairs, they're probably going to deny your new deal.
So it will, yeah, it'll track with you.
It will. A check tracks with you. Yep.
Yeah.
You can.
So we've seen a couple people that have attempted to get off of a check that they were originally denied and then softened up a little bit where you can still do a loan with Fannie Mae, but you're not going to get any exceptions. You're not going to get 3 years of interest only. You may not even get any interest only. You may not get 75, but you may get 65 or 60% leverage on these deals. So as I say, don't get on a check. Going back, Fritz, I mean, we can ask this question 10 different ways, and we can stay on the phone here with Josh, and he's a wealth of information. But what happens if you do want to sell the property? You've done the PCAs come back because it's been rated a 4, that $500,000, but there's equity into the deal. But you want to do a supplemental because the next person coming in wants to get higher leverage in the deal. So they don't want the 50% leverage, but they want the 65% leverage. And the supplemental goes from the 50 up, brings it up to 65. It's like, a second lien against the property itself. What's our take if the property is rated a 4? We have $500,000 again, the $500,000, I would imagine if we did supplemental, it would go back into the property, or would they even allow the supplemental with a 4 rating?
I think it would be difficult to get a supplemental done to fund. Essentially, I think what you're asking is do you get a supplemental then to fund the repairs?
Right.
And I would say that is not something that we've seen Fannie and our credit teams get comfortable with.
It is a different world these days with what apartment investing has been in the past and what it is today. And we just want to kind of bring everybody into the conversation that we're having on a day-to-day basis with I would say the overlords of maintenance and management and all the operations of the property, and seeing what they see on other deals versus the deals that we're seeing. James, any last questions?
No, I think that's it. I mean, I think Fritz hit on it earlier, and we talked about it a little bit yesterday at this conference, was really this over communication and responsiveness. I know the Colliers team does we work through a lot of asset management stuff with them, and just, whether it's draws, whether it's immediate repairs, I think everybody's reasonable to some extent, and just working through these things. I think if you're showing good faith and getting it done, they're going to work with you. But if the second that you become difficult, the lender has the biggest stick. So remember that. So we've had some borrowers forget that sometimes.
Yeah, we talked about at the conference, and again, this was a Colliers conference. They showed, as of the end of December, $911 million in the foreclosure pipeline just in Texas. And that Texas is the number one state of foreclosures. Not Colliers, but the number one state. And so we're starting to see distress in assets, and that is like having a debt service coverage ratio of less than 1%. So we have an NOI of $100,000, but you have a mortgage of $100,000. That's 1.0. But if you have less, if the mortgage stays at 100, but now you have 85% income coming in, that's distress. And so San Antonio has 33% of its properties that we're starting to see distress. Houston, 30%. Austin, 29%. And Dallas-Fort Worth, 27%. So there is a level of distress in the market. That's why I think it's so important for us to kind of talk a little bit more about it right now. These are permanent loans. They're in place. They have a longer maturity. So if the market does have a problem, we typically can have enough maturity to wait it out. And I tell you, thank God some of the people did take Fannie Mae and Freddie Mac long-term fixed rates in 2019, 2017, 18, and they're just kind of waiting it out. So again, we just wanted to kind of talk a little bit about the rules of the road. Josh, anything that we forgot, we left out that you think is important that everybody who listens to us should follow?
Yeah, probably a good point to reiterate with what I'm seeing across the market, and thing we haven't touched on it is third-party management. We are seeing deals that are getting brought on and third-party management, and they're going south quickly. A lot of third-party management companies came on the market in the last 5-7 years. Not all of them are as quality as the others. So I recommend very strongly that you know what's going on. You're involved, especially the first year, with the management company, with the property manager. So I tell everybody, like, it's worth the price of a plane ticket once a quarter just to get your face in there the first year, and they know the owner of the property is out there. You'll save yourself a lot of headaches saying, well, I didn't know this was going on. And then that's to the flip side of that point, which I mentioned earlier, Paul, was that there's a lot of deals out there, because there's a lot of these deals that went south because they were just mismanaged, but the value is just there. And so there is some really good opportunity at this time too. So both sides can be true.
Fritz, any final words? And then we'll have the professor say the.
I think we've covered a lot of it. Really happy that we can get Josh on the podcast because he's a wealth of knowledge and sees a lot of different deals, all not just in Texas, but all around the country. So I think it was great to have him on and have your audience get a sense of what we're looking at on a daily basis.
Great. Professor?
Come on down. Come see your properties in Dallas and come see us at the conference in September. That's it.
All right. So the gentleman from Colliers, we certainly do appreciate you spending some time with us and just educating us and giving us a little bit more feedback of what you're seeing in the market. So Josh, thank you very much. Fritz, thank you very much. And the professor, always a pleasure. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.